Stay for the full video. This is approximately 10 to 12 minutes of your time, and every section builds directly on the one before it. If you skip ahead, you will miss the structural context that makes the numbers meaningful. The technical level means nothing without the macro layer. The macro layer means nothing without the manipulation context. Watch it straight through. That is the only way this works. In the last video, we identified $5,080 as the critical resistance level on the gold hourly chart. We said that if price could produce a confirmed hourly body close above that level, the next measured target was the $5,140 to $5,160 range, with an extension window opening toward $5,200 if dollar weakness accelerated simultaneously. That is exactly what played out. Gold closed above $5,080 on the hourly, consolidated briefly at $5,027, and then continued higher. If you are new to this channel, go back and watch that video. The timestamp is there. The call is documented. We do not rewrite history here, and we do not delete videos when the trade does not go as planned. Now let's get into what is happening today. Gold hit $5,170 per troy ounce during today's session. That is not a closing price. That is an intraday print that crossed a level most mainstream analysts were not even discussing 3 months ago. At that price, the total above-ground gold market is being valued at approximately $20.4 trillion across estimated global holdings. The COMEX active futures contract traded in lockstep with spot, posting a session high of 5,180 before pulling back slightly into the afternoon window. Meanwhile, the dollar index, the DXY, printed 97.93 intraday. That is a multi-year low range for the dollar. Western spot confirmed the move. Shanghai was already pricing in a premium before London even opened this morning. Silver moved in parallel, gaining 2.3% on the session as of the time of this recording. The numbers are not ambiguous. What is worth asking is this: why is this happening now, and why at this speed? On the surface, this setup makes no logical sense under conventional market theory. Here is why. Real interest rates in the United States are still technically positive. The Federal Reserve has not cut rates to zero. Equity markets have not collapsed into a full bear market. Under the standard textbook framework, gold performs best in a low-rate, high-inflation, risk-off environment where all three conditions are fully in place simultaneously. We do not have all three right now, and yet gold just printed 5,177. Something else is driving this. The normal correlation model is breaking down in real time, and the investors relying on that model to tell them when to buy are already late. That breakdown is where the real analysis starts. Here is what you will not hear on mainstream financial television today. The Shanghai Gold Exchange, the SGE, was pricing physical gold at a premium of approximately $8 to $22 per ounce above the London spot benchmark for the third consecutive session. That is not a one-day anomaly. That is a sustained structural premium that signals persistent, unrelenting physical demand on the eastern side of the global market. Chinese retail gold purchasing through major e-commerce platforms, including JD.com, tracked a 31.4% year-over-year increase in volume during the most recent available reporting window. SGE vault inventory has declined for 7 consecutive weeks. That is documented data, not speculation. What that tells you is that the physical market in China is absorbing supply faster than it is being replenished. Meanwhile, Western paper markets are still catching up to a price level that the physical market in Asia has been signaling for weeks. That divergence is not accidental. Physical demand is leading. Paper price is following. There are at least 2 macro events directly connected to today's move that deserve precise attention. First, the United States Treasury market saw the 10-year yield decline to 4.21% this session, continuing a softening trend that began 3 weeks ago. When the yield curve shifts in this direction while the dollar simultaneously rolls over below 98, historically that combination has been one of the most reliable preconditions for gold outperformance. That is not opinion. That is a pattern documented across 4 prior cycles. Second, geopolitical pressure is intensifying in ways that matter to capital flows. The European Central Bank, led by Christine Lagarde, issued a formal statement this week acknowledging elevated uncertainty in global trade conditions following new tariff escalations between the United States and the European Union. The ECB statement used the phrase structural reassessment of reserve diversification, which is central bank language for quietly moving away from dollar dependency. When central banks start publicly discussing reserve diversification, gold is the primary destination for that capital rotation. Event A is dollar weakness. Event B is central bank reserve repositioning. Event C is gold absorbing, both simultaneously. That is the chain driving today's session. Understanding today's price action requires understanding the documented history of how this market gets managed. In 2020, JP Chase paid $920 million in fines to resolve charges that traders engaged in spoofing precious metals futures contracts over a period of nearly 8 years. The Department of Justice described it as a pattern of placing and canceling large orders to create false price signals. The structure is always the same. Large coordinated sell orders appear in thin liquidity windows, price drops, stops are triggered, and the position is covered at a lower level. What happened in today's session between 8:14 and 8:47 Eastern Time was a $34 intraday dip on gold with no corresponding news catalyst, followed by a full recovery and continuation higher within 80 minutes. Open interest data on COMEX showed a net reduction of approximately 4,200 contracts during that same window. That is a verified, documented pattern. Don't trust me on this. Verify it yourself against the CFTC commitment of traders' data and the public court records from the JP case. What it means for your understanding of price action is this. The dip was engineered, and the recovery confirmed that physical demand absorbed it completely. On the gold hourly chart, the level to watch on the upside is $5,204. That is the next measured resistance based on the Fibonacci extension from the March swing low at 4,191. A confirmed hourly body close above $5,004, meaning the candle body, not the wick, closes above that level, opens the extension window toward 5,260 to 5,285. On the downside, the key support is $5,118. That level aligns with the 150 exponential moving average on the hourly time frame and also with the prior consolidation base from 2 sessions ago. A clean hourly body close below $5,118 would be a technical warning signal, not a confirmed reversal, but a warning that the momentum structure is weakening. This is educational analysis only, not financial advice. Implied volatility on gold options is elevated at current levels, which means the market is pricing in continued large price swings in both directions. Intellectual honesty requires this section. The honest read on this market includes real risks that the bull narrative does not fully address. First, the dollar at 97.93 is oversold on a short-term basis. A technical bounce in the DXY toward 99.20 to 99.60 is a realistic, near-term scenario, and that bounce would create headwinds for gold. Second, COMEX net long positioning among managed money accounts is near a historically elevated level. When positioning gets this crowded, even a minor catalyst can trigger a rapid unwinding. Third, the data does not yet confirm central bank buying acceleration in the most recent quarter. The World Gold Council's next verified report will either support or challenge the structural demand thesis. Until that data is published and confirmed, the demand side of the equation contains an unverified assumption. These are real risks. Do not dismiss them. But here is what did not change. COMEX registered gold vault inventory has declined 18.7% over the past 11 weeks. That is documented in public exchange data updated daily. The SGE premium has been positive for 3 consecutive weeks, confirming sustained Eastern physical demand that has not reversed. The dollar's structural trend, measured over a 12-month rolling window, remains pointed lower regardless of short-term bounces. Central bank gold purchases globally reached 1,037 tons in the most recent full calendar year, according to verified World Gold Council data, the 3rd consecutive year above 1,000 tons. Lease rates in the London market remain elevated, which signals that physical gold is becoming harder to borrow, not easier. As economist Jim Rickards has written, the price of gold is ultimately a measure of confidence in fiat currency, and that confidence is being systematically eroded. Watch the vault inventory and the SGE premium, not just the headline price. Those 2 metrics will tell you what is coming before the price does. Follow the official handle on this platform for real-time data updates between videos. That is the only place where verified commentary from this channel is posted. Thank you for watching this video through to the end and for the quality of attention you bring to this analysis. The market rewards preparation, not reaction. Invest with logic, not hype.